Hello, this video is over mergers and acquisitions. I'm your professor, Dr. Stephen Haggard. So what is a merger or acquisition? It's where we start out with more than one firm and we end up with a single firm. Now there's some subtlety in the nomenclature here. An acquisition means basically that you are acquiring or buying another firm. Merger has more the feeling of we're putting together two firms to make a new firm. Now, in reality, it's usually one firm is taking over another. And there was recently an article in the Wall Street Journal about this, that mergers of equals are hardly ever actually mergers of equals. And so what we're really going to talk about here is how one firm is the bidder and the other firm is the target. So the bidder is the firm that's out there trying to buy another company, and the target is the company that they're trying to buy. Okay, so now let's assume you're a target shareholder and your shares are currently trading at $20 a piece. If you wanted to sell your shares for $20 a piece, you would have already done so. In other words, the bidder is going to have to offer you more than $20 a share to get you to sell. And so that extra money they have to offer you is called the merger premium. And the fact that the bidder has to offer more than the market value for the shares means that target shareholders will always win in a completed acquisition, because they will always get a higher price than the market says their stock is truly worth, and a higher price than they would have got if they had not had this acquisition enter the picture. Okay, so now the next question is this. We know the target shareholders always win, but what about the shareholders of the bidding firm? Well, according to Roll 1986, the total gains, in other words, bidder plus target gains to an acquisition, are non-positive. What does non-positive mean? Zero or negative. And so since we know that the target shareholders always must win, in essence, this means that on average, the bidding shareholders must lose if the gains to acquisitions are non-positive. And so we start to have this question, why in the world are these bidding managers making these offers? Remember, the goal of financial management is to maximize shareholder wealth. Bidding managers are responsible for maximizing the wealth of their own shareholders, not the target shareholders, but their own shareholders. And so just looking at these things, on average, we would assume that a smart manager would avoid making an acquisition, since it is likely to hurt his or her shareholders. Now, we're going to talk about why that might be. And the first has to do with misvaluation. Misvaluation is where the managers of the bidding firm think that the target's standalone value, in other words, the target company by itself, they think that the market is currently undervaluing that. And so let's say the stock is trading at $20 and the managers do their calculation and they say, wow, this firm is actually worth $25. They might go out and offer $22 and think they were getting a good deal. But the problem is this. First of all, the current market price we know in an efficient market is our very best guess for the true value of the firm. And we know that any sort of estimation that we do for the value of the firm is prone to error. And what Roll says, Richard Roll, the author of our paper that we're reading, what he says is that these estimates of the value are basically going to be normally distributed about that current stock price. But we're only going to observe bids when the managers err on the high side with their valuation. Because after all, if their calculation said the target firm was only worth $18, are they going to go out and make an offer of $18 a share for a firm that could be sold right now for $20 a share? It wouldn't make any sense. And so we really only observe half of the estimates that we see from bidding managers, the half that overestimate the value of the target. So why would managers think their estimate of the value of the target is correct and that the market is incorrect? And keep in mind that the market price is everybody else's opinions mixed together as to what the true value of this firm is. Everybody out there has a little bit of information that they can impound into this price, and that's why we say in an efficient market, it is our very best guess of the true value of the firm. Why do these managers think that they know better than everybody else? The answer is hubris. Hubris is excessive pride or arrogance. And that is, the entire paper is called the hubris hypothesis because Richard Roll hypothesizes that hubris is what causes these managers to make these offers for target firms. So why do managers think that their management of target firms is going to be more efficient than the current management of those firms? This is one of the arguments that we hear from managers. They say, oh, we're so much better than the current managers of this firm. Certainly we can do a better job. In fact, in my industry experience, when I was working for Halliburton, we acquired a company called Dresser. And I was actually dispatched to a Dresser plant to explain the superior Halliburton system to these poor unenlightened people. And when I got there, it turned out that they were actually doing a better job than we were at Halliburton. And the things that they were doing that we thought were strange, actually they had a good reason for doing them, and we kept doing them once we found out what those reasons were. In other words, we were not the super managers we thought, and they were not the poor managers that we thought. Why did we think we were super managers? Hubris, excessive pride or arrogance. So why do managers think that they're going to be successful in making acquisitions work when so many have failed before? Let me tell you what I mean by failed acquisitions. You can go through and look at a lot of different firms and see where they've had to spin off or sell things that they previously acquired. For instance, Ford Motor Company used to own both Jaguar and Land Rover, but they had to sell them. They couldn't make money with them. And other firms, let's talk about General Electric. General Electric has acquired a lot of businesses they've recently had to sell. And we see eBay. eBay bought Skype. Couldn't make any money with it, so they ended up spinning it out, and now Microsoft has bought it. And so we see a lot of acquisitions fail. In fact, I would say the majority aren't stellar. And so why would a manager say, but I can do better? And the answer once again is hubris. It's hubris. So now the big question is, even people who are arrogant or hubristic, even those people can learn from their mistakes and might eventually stop doing this sort of thing. Roll says that the reason we don't observe that in the real world is that over a manager's career, they have so few opportunities to make these acquisitions that they don't have a big enough sample size to learn from. And they tend to chalk up their bad experiences to bad luck or bad timing or things outside their control. And so they are not dissuaded in the least from trying again. And so we see that it's a bit of hubris there, along with inexperience, that leads managers to continue to try to do these kinds of acquisitions. Okay, so it's possible, by the way, if the investing public thinks that a merger is a bad idea, of course the price of the target will go up because of the merger premium when the offer is announced, but the price of the bidding firm will go down to represent the value transfer from the bidding firm to the target firm. because we're going to assume that the gains are, of course, non-positive. And so it's just basically a wealth transfer from one set of shareholders to the other. And so you might say, okay, well, I just saw an announcement and the bidding firm's stock price actually went up. So the investing public must think that this is a good acquisition. And that's not necessarily true, because the bid itself might actually release new information about the bidding firm. I'll give you an example. I used to drive a 2001 Nissan Sentra, and it was a good car, but it was old and it smelled funny and it made noises. But being a professor, I can get by with driving such things. And let's assume that you saw me driving that for 2 years, and then one day I pull into the parking lot in a brand new Porsche 911. You might ask yourself, what's going on here? And so I pull into the parking lot, and as I get out of the car, I say, or you say, nice car, Dr. Haggard, and I say, thanks. Now, at this point, your estimate of my wealth has probably gone up as a result of seeing me with this new car. And further, when I say I wrote a check for it, now your estimate of my wealth goes up even further, because after all, it could have been a lease. And this is the same thing that we see when bidding firms go out and bid for targets. Sometimes they are releasing information about the fact that managers expect the future cash flows of the firm to be higher than we expect them to be. And so you might see the stock price go up on that announcement. But here's how you can tell if the market thinks it's a truly bad idea. After that initial rise in price, as the takeover becomes more likely, what happens is that share price starts to go down, because that share price is starting to impound the news of the completed acquisition. At any given time, what will be represented in the bidder's share price will be the probability of the deal completing times the gain or loss if the deal gets completed. And so if we think there's only a 50% chance this thing will go through, half the damage will be represented in the share price. But when we think it's 75% likely to go through, then 3/4 of the damage will be reflected in the share price. And then when the deal finally closes, 100% of the bad news will be impounded into the bidder's share price. So, there are a couple of ways that companies pay for acquisitions, and let's just say cash and stock. Now, there are other things involved here, but let's make it simple: cash and stock. And the market views these things differently, and let's explain why that is. First of all, if a firm makes a cash offer, it says they either have the cash on hand or they are in good enough shape that they can use debt to raise the cash to pay for the acquisition. And it also says that they think the acquisition is a good idea. Let's talk about why that is. If I use stock to fund the acquisition, then the target shareholders will get to share in the gains of the acquisition. However, if I use cash, then I can keep all of those gains after the payment to the target shareholders for my current shareholders, because no new shareholders come into the picture. So what does that mean? If I have to share gains, I'm less likely to want to issue stock. But what would make me more likely to want to issue stock? What if the acquisition's actually a bad idea? Then I would like to use stock because I want to protect my current shareholders from some of those losses. In other words, I'm going to be sharing the losses with the target shareholders. That's a bad deal. And so those are some reasons that we might see a cash offer be more favorably received than a stock offer. Also, if a manager is offering their shares for anything, whether it's another business or as a secondary equity offering, Anytime managers offer up their shares, we have to wonder, do they know something we don't? Do they know that these shares are overvalued? For example, if the managers think the shares are really worth 25, but they're currently trading at 28, certainly they would be glad to sell you a share and pocket the extra $3. And so that's another reason that we see cash being more favorably received than stock. When we see people negotiating better deals in acquisitions, oftentimes the total amount of dollars doesn't actually change. It's the composition of stock and cash. And the better deal almost always includes more cash and less stock. So that's one more piece of evidence that the market prefers cash. So, all things considered, it looks like these mergers and acquisitions probably don't create a great amount of value, if any. And so you might be saying, what does that mean to me as an investor? Well, I will tell you, as a well-diversified investor, I really don't care all that much, because I own probably the shares of both the bidding firm and the target firm. And so while I might lose value in one of my investments, I gain it in another. Now, that doesn't account for the transactions costs of mergers, which are significant, and it also doesn't account for any sort of capital gains taxes that I might have to pay as a shareholder in the target firm. But overall, as a well-diversified investor, I'm certainly far less concerned about this behavior than my friends who hold undiversified portfolios.